The 1980s and 1990s often featured Fed chairs Paul Volcker and Alan Greenspan lecturing to Congress that if lawmakers wanted lower interest rates, they needed to rein in public deficits. Fast forward 3 decades, and we see that mantra flipped on its head. Now, Fed Chair Jerome Powell tells Congress that the economy needs more fiscal support to offset the pandemic, even as the U.S. budget deficit is already a record 14% of GDP. Currently, there are several proposals for pandemic relief, ranging from the skinny $350 billion Senate proposal to the $1.8 trillion White House offer to the $2.2 trillion in stimulus advocated by the majority in the House of Representatives. Every $200 billion in additional stimulus adds about 1% of GDP to the deficit. As such, either the proposal from the White House or from the House of Representatives could bring the deficit to 23 to 25% of GDP. This raises questions for bond investors that relate back to the Fed. When the first stimulus package passed Congress in March, the Fed bought much of the newly issued debt, and supported by Fed buying, longer-term bond yields remained low and stable. But would the Fed buy such a large portion of a second round of stimulus? And if not, will bond yields rise? A case can be made either way. On the one hand, back in March, equity prices had fallen 30% and credit spreads were widening. The Fed bought bonds not just to absorb rising federal debt, but also to stave off a credit crunch. Now stocks are near record highs and credit markets are functioning well. So the Fed might be less inclined to do a second massive round of QE. On the other hand, between 2009 and 2014, the Fed did 3 successive waves of QE, and the last 2 came even as equity prices rose and the economy recovered. In addition, looming consumer and business defaults could justify more Fed buying. Essentially, bond investors face several layers of uncertainty. First, what kind of stimulus bill might eventually be signed into law? Second, when will Congress and the White House reach an agreement? 3, how much of the newly issued debt might be absorbed onto the Fed's balance sheet? And finally, 4, how much might the yield curve steepen if the Fed doesn't buy a significant portion of that debt? In the meantime, investors will watch closely for signals from Washington. And it's not just bond investors who will be impacted. A steep rise in long-term bond yields could also pull investors away from stocks and precious metals. I'm Eric Norland, Senior Economist at the CME Group in London.